Top 10 things every investor should know. Are you new to investing and looking for guidance? Unsure of how to make your money work for you? Don't worry. In this informative video, we will unveil 10 essential investment strategies that are crucial for everyone to grasp. By learning these strategies, you will gain valuable insights to make informed investment decisions and enhance your potential for future financial gains. Without wasting any more time, let's jump right into the video and learn the essential knowledge that will help us succeed in the world of investments. The Rule of 72, a powerful investment tool. Many investors often wonder how long it takes for their money to double. The Rule of 72 is a handy tool for a quick estimation. Simply divide 72 by the expected rate of return to determine the approximate time it takes for your investment to double. For instance, if you assume a 12% rate of return, dividing 72 by 12 reveals your money would be double in about 6 years. This rule provides insight into the level of return and associated risk required to achieve your desired doubling time frame, such as every 3 to 4 years. Investing in isolation is never a wise choice. Having clear goals is crucial for successful investing. It's not enough to simply want to do well or retire comfortably without specifics. Your investment portfolio should match your specific objectives, risk tolerance, and time horizon. Think of investing as a journey. You need to know your destination to know when you've reached it. Your advantage over the professionals. Gaining an edge over professional money managers involves recognizing their constant pressure to outperform the market in the short term. They face the risk of taking on excessive risks to beat benchmarks and peers. Unlike them, you're not bound by the need for immediate performance measurement. You can adopt a long-term perspective, remain patient, and weather market downturns without undue concern. The critical role of asset allocation in investing. When you invest your money, how you divide it among different types of investments is more crucial than selecting specific stocks or hoping for lucky investments. A study by Ibbotson reveals that asset allocation determines more than 91% of your overall portfolio performance. By thoughtfully selecting and combining different asset classes, you build a strong base for long-term investment success. Don't let taxes dictate investment decisions. Focus on portfolio objectives. Tax-related choices undoubtedly affect the overall performance of a portfolio, but basing investment decisions solely on tax considerations can lead to negative outcomes. We have observed instances where investors hold on to an asset for an extended period merely to avoid paying capital gains taxes upon selling it. Unfortunately, this approach often leads to significantly larger losses when the asset's price declines. It is essential to make rational investment decisions grounded in logic rather than allowing tax-related emotions to influence your choices. Navigating the risks of investing. Regardless of the investment choice, there is always a certain level of risk involved. Even if you opt for highly conservative investments like CDs, you still face risks related to inflation and generating income. Similarly, investing in bonds can sometimes carry as much risk as investing in stocks. Understanding the link between return and risk in investing. The pursuit of higher investment returns involves taking on increased risk, although it does not always guarantee success. While seeking higher returns typically requires assuming greater risk, it is essential to consider potential losses and the possibility of investments not generating substantial returns. Remember the wise words of Mark Twain, "I am more concerned about the return of my money than the return on my money." Company quality doesn't guarantee stock excellence. It's surprising to think that a big and famous company may not always be a great choice for investing. Even though they may be considered good or even excellent companies, they can still face difficulties just like lesser-known ones. In reality, many well-established companies become stagnant and struggle to expand beyond their usual limits. Investing too much in these big companies can actually have a negative impact on your investment portfolio. Spread out your money and limit risk. This incredible two-in-one solution. To mitigate risk, avoid putting more than 10% of your portfolio in any single stock, including your company's stock. This applies especially to investors using their 401k plans with company stock options. Additionally, diversify your portfolio across different holdings, considering the aggregate rather than individual accounts. Remember that every stock you buy was sold by someone else, and excessive exposure can lead to significant losses. Learn from past stock blunders like Enron, WorldCom, and Kmart, where many investors suffered due to holding excessive positions. Protect yourself by limiting your exposure and maintaining a well-diversified portfolio. Be mindful of your media consumption. Switch off the TV and avoid reading investment magazines too much. These sources can give you some helpful information, but they care more about making money from subscriptions and attracting viewers than providing good advice. The recommendations they give may not always be the best for investors. Remember, news is designed to get our attention, but it doesn't usually bring us good news when it comes to investing. And that's all. These are fundamental investment strategies that can greatly assist you in considering where to invest your money. Now, which strategy resonated with you the most? Please share your thoughts in the comment section below.